What is up, guys? My name is Gifford and welcome to my first video on the stock market journey. Today I'm going to be going over the 3 stocks that I'm going to be buying through June on the Sharesies platform, so it's on the NZX. I will do another one for Hatch later on, but for this one it's just a quick video to show you what stocks that I'm choosing over. So just having a look at the NZX50 here, we can see the big dip, and I'm a little bit gutted because I didn't actually start investing in Sharesies up until this point here. I didn't create my account, so I wasn't able to sort of take advantage of this slot here. If we go back, so in January is when I started my stock market investing, but that was only through ETFs and index funds. I've shown it on another video what I was investing in then. So this was all new to me, and yeah, I started investing here, as we can soon see. Now, before we get onto Sharesies, let me just, it was a crazy, as you can see, the crazy recovery here. There's also a lot of crazy stuff happening, like someone paying $50 for this kiwi-shaped feijoa, which why buy $50 worth of stocks when you can buy this fruit? Anyway, carrying on. So going on to Sharesies, my current portfolio is 5,494. And this here, the yellow part, is the ETFs and index funds. Now, if we go down a bit, we can see that I'm still down a little bit, total return by less than 1%. And that's basically because of the investing I did before the big dip. And when the dip did come, and I did have Sharesies, I was kind of hesitant to buy any more because everything was going down. So as a new investor, I was quite cautious when I should really have been buying. Okay, so I've also got my Hatch there, which is the total is $520, and also my Sharesies portfolio. So let's go into Sharesies. So currently my Sharesies portfolio is 536, and I've invested in a few companies, but the 3 companies I want to talk about is, one of the ones that I first bought is Ryman Healthcare. So they are a health provider. They look after the retirement villages. See here that I bought them 3 times on the way up. So one of the reasons why I bought Ryman Healthcare is that their share price had been rising all up until the dip, but they've actually recovered pretty well. If we have a look at their 52 range, they went as low as $6.61 and as high as $17.20. Now, they have a market cap of $6.83 billion. The PE ratio is quite good, so I try to go for companies that are around about 20, but that's not always the case. So if we go to Simply Wall Street, a couple of indicators that I look for is the summary. So they think that Ryman Healthcare is 51% below its fair value, and that the revenue is forecasted to grow 10.8% in the next year. Now, if we have a look at the valuation, we can see here how undervalued it is. So the current price at the moment they've got it here is $13.45. They just have to be careful of this fair value here because they say it's $27. But if we actually have a look at the share price and hit max, we can see that the max price that's ever gone up is $17.20. So yeah, so when I realized that, I've just got to be cautious of these prices here, because as someone learning, I don't quite know yet how to value a company properly, so I kind of go off this here. Let me adjust the camera for a little bit. So some of the indicators I look for is financial health, and we can see here that it says that Ryman Healthcare has Ryman Healthcare short-term assets that exceed its short-term liabilities, so that's good. It's long-term liabilities, however, they're a bit short on that, so that's a bit of a risk there. And as we can see here, it's actually minus 12.5%. Now, the reason why I still keep buying into them, because I think that the share price is going to keep going up. If we just go back to Yahoo and go back for the last 5 years, we can see here that it has been increasing. So during the lockdown, I know that everyone was safe, so their facilities had good health and safety, so I don't see any reason or a big threat to why the share price would come down. I also have a look at the CEO and how long he's there, because that's very important. So going back to Sharesies, we can see that I've got 6.2 shares in it and I'm 7.5%. It's still relatively small compared to my whole portfolio, so I'll be adding to this during June, just dollar cost averaging across it and just buying weekly. Okay, so the next stock I will be buying is Restaurant Brands. So they own takeaway places like KFC, Pizza Hut, and Carl's Jr. You can see here that the 52-week low again was at 6.4, and the highest they got was 14.3. Their market cap's much lower than Ryman, so $1.6 billion, and they have quite a high PE ratio of 44. So having a look at Simply Wall Street, I can see here that the trading is at 7.8% of their fair value. Their earnings are forecasted to grow at 35%, and the earnings have grown 10.9% for the last year. One of the reasons why I chose restaurant brands is because that they have continued to raise their share price all the way up until the dip, and they recovered quite quickly. So again, I'm just a bit gutted that I didn't buy down here in the lower part, but anyway, I didn't have Sharesies then. So having a look at their valuation, they think it's at about 7.8%. So I think that this will continue to go up over time. Having a look at their financial health, they are saying here that the risks are they don't cover their short-term liabilities or the long-term liabilities, so that's not very good. So that there actually confuses me, because why is the share price going up while these guys can't cover the liabilities? So I'm definitely going to have to read some balance sheets and to understand what's going on there. So just one thing to point out is that I know that dividend investing is really popular with other people, but myself, I don't really look for companies to get their dividends. I'm trying to find companies that go up in share value and growth companies whenever I can figure that out. I have other ways to get passive incomes. It's great if there is a company does give dividends. I don't mind that. I'll reinvest them, but I don't acquire companies just for their dividends. The company I'm going to be depositing weekly in is Summerset. I'm currently 11% up on that with 6.4 shares. So again, very small holdings there, but if we go into there, we can see that I've bought them twice recently, and if we just go to the 6-month average, we can see that they're actually plateaued out and they are still recovering from their original price of $9. So why did I buy these? So I saw these YouTube videos that they were recommending this stock, so I looked into it myself. These were one of the earlier ones that I had acquired. So if we have a look at here on Yahoo, the 52-day range is $3.36 and the highest is $9.30. Again, that would have been great to have bought it at the low end, but the market cap is $1.5 billion, so a little bit smaller than Ryman Healthcare. The PE ratio is pretty good. That's below 10. Simply Wall Street, we can see here that they're trading 65% their value, and their revenue is forecast to grow 11% in the year. So they do have some risks there that they see, that they're going to decline 8% per year, and they have a lot of debt. So that's something to watch out for. Now, if we go to the share price, we'll go to valuation. So they think they're undervalued and their fair value is $18, but we can see from their share price that the highest they've ever gone up is $9, which is almost twice as much as what their fair value is. So again, something to watch out for. That valuation is not quite right, but I still think that they're relatively cheap at $6. I can see them increasing from the videos that I was watching, that they had some very good points on them. Financial health. So again, this one here is that they can't cover their short-term liabilities. So that's definitely a risk, and their long-term liabilities. Do I see them going out of business anytime soon? I don't think so, but I do need to understand why this website is saying that they can't cover their liabilities. So a bit more reading into the balance sheets of these companies that I'm putting money into and really understanding them. So this here is quite interesting. It says inside trading volume. So I look at this sometimes. The insiders are buying, and there has been quite a bit of activity. There was a lot of selling, and then there has been buying recently. So that's good signs. So another tab I like to look at here is the ownership, and we can see the inside trading volume. So we can see that there was a big sell-off about 3 to 6 months ago, and then that there was a bit of buying recently. So that's quite encouraging, but it does state here that inside buying, some of the insiders have sold more shares than they have brought in the past 3 months. So that's what I've been buying and what I'm going to be buying continuing this month in my Sharesies. So I do need to understand a lot more about the stocks that I'm buying instead of just sort of looking at these numbers and the share price and then just purchasing them. I need to understand a bit more about the company, understand more of the metrics, the liabilities, and probably read some balance sheets and watch some more YouTube videos and really understand where I'm putting my money. I hope to do another one for Hatch as I slowly move away from ETFs and put more money into individual companies. The main reason is that there's more gains, although I do feel like I've missed the boat. It's better to have started than not at all. So as you can see, the ETFs are still actually recovering and we're still minus, and these individual companies here, although I've just started recently and missed the dips on them, they're all up by a little bit. So I've just got to put a bit more money in, understand a bit more, and maybe watch some more YouTube videos, find some tips on what the others are recommending. So on that note, if you have any tips for me on any companies that I should look into as a beginner, feel free to type them in the comments. Otherwise, I will see you in the next video. Bye.